Energy Fuels Inc., NYSE American, UUUU, experienced a significant surge in its stock price, climbing 41.82% over the past week, closing at $9.36. This rise was driven by the company's announcement of initiating production of heavy rare earth oxide, specifically dysprosium oxide, at its White Mesa mill in Utah. Dysprosium oxide, used in manufacturing rare earth metals, alloys, and magnets, is expected to achieve a purity level of over 99.5%. Energy Fuels plans to produce 15 kilograms by the end of September 2025, which will allow it to supply its terbium circuit starting in October 2025. The company's strategic move into rare earth production positions it uniquely in the U.S. market, potentially reducing reliance on foreign suppliers for these critical materials. This development aligns with broader trends in the industry, where demand for rare earth elements is increasing due to their essential role in high-tech and green technologies. However, while Energy Fuels stock has shown impressive gains, some analysts suggest that opportunities in the artificial intelligence sector may offer even higher potential returns, highlighting the dynamic nature of investment opportunities in the current market landscape.
Private equity giant Blackstone has exited a consortium aiming to invest in TikTok's U.S. operations, reflecting the growing complexities and uncertainties surrounding the deal. The consortium, led by Susquehanna International Group and General Atlantic, was poised to acquire an 80% stake in TikTok's U.S. operations, with ByteDance retaining a minority interest. This development comes amid ongoing U.S.-China trade tensions and a series of executive orders from President Donald Trump mandating ByteDance to divest TikTok's U.S. assets or face a ban. The deadline for this divestment has been repeatedly extended, stirring criticism from lawmakers concerned about national security implications. The uncertainty in TikTok's future is exacerbated by China's reluctance to approve the transaction, especially after the U.S. announced new tariffs on Chinese goods. Despite these hurdles, ByteDance is exploring options to comply with U.S. demands, including potential restructuring or sale of its U.S. operations. TikTok's robust financial performance, surpassing Meta in quarterly revenue, underscores its value, making the stakes high for involved parties. The outcome of these negotiations could significantly impact U.S.-China trade relations and the strategic positioning of TikTok in the U.S. market.
Chevron has successfully closed its $55 billion acquisition of Hess Corporation after overcoming a protracted arbitration challenge from Exxon Mobil. The dispute centered on Hess's 30% stake in Guyana's Stabroek Block, a lucrative offshore oil field with over 11 billion barrels of oil. Exxon, which operates the Guyana project and holds a 45% stake, attempted to block the merger, citing a right of first refusal on Hess's assets. Although Chevron ultimately prevailed, the year-long delay cost the company significant revenue and slowed its strategic integration plan. This acquisition is part of a larger consolidation trend in the oil industry, countering Exxon's own expansion in the Permian Basin. The arbitration delay impacted Chevron's financial performance, with the company missing out on approximately 180,000 barrels per day of Hess oil and an estimated $3 billion in profit from Guyana. Despite the favorable ruling, Chevron's shares have declined about 9% since the deal's announcement, reflecting investor concerns over execution and timing. Conversely, Exxon's stock has risen slightly following its successful $60 billion acquisition of Pioneer Natural Resources, highlighting a divergence in investor sentiment. With the arbitration resolved, Chevron plans to achieve $1 billion in cost synergies by 2025, although it will also face job cuts due to overlapping roles with Hess.
Joby Aviation Inc., NYSE Joby, experienced a significant 47.67% increase in its stock price over the past week, closing at $17.78 due to heightened investor confidence following the announcement of its aggressive expansion plans. The company revealed its ongoing expansion in Dayton, Ohio and Marina, California, aimed at boosting its production capacity to 524 aircraft annually respectively. These expansions are part of Joby's broader strategy to enhance its manufacturing capabilities across its 4 sites, which also include facilities in Santa Cruz, California. The marina site will further support the company by providing essential services such as initial FAA production certification and pilot training simulators. Backed by Toyota Motors, Joby Aviation is poised to release its second quarter earnings in early August 2025. The company's recent expansion efforts have positively influenced market sentiment, as evidenced by the sharp increase in its stock price. This move aligns with Joby's broader strategic goal of scaling up its production capabilities, potentially positioning the company as a significant player in the electric vertical takeoff and landing (eVTOL) aircraft market. However, while Joby's growth prospects are promising, some investors remain focused on the potential of AI stocks, which are perceived to offer higher returns within shorter timeframes.
QuantumScape Corporation, NYSEQS, has experienced a significant surge in its stock price, rising 51.68% over the past week, driven by investor optimism surrounding a new production milestone. The company recently announced the implementation of its Cobra separator process, which enhances production efficiency by significantly improving heat treatment speed and reducing the physical space required for production. This advancement is pivotal for scaling up QuantumScape's Gigafactory production line and positions the company favorably ahead of its second quarter earnings release, scheduled for July 23. The Cobra process offers approximately 25x improvement in heat treatment speed compared to the previous Raptor process, marking a substantial leap in manufacturing capabilities. This development has bolstered investor confidence, leading to a 9-day rally in QuantumScape stock. As the company prepares to release its earnings report, market participants are keenly observing its updated outlook for the remainder of the year. Particularly in light of the enhanced production capabilities, this positive momentum underscores the market's anticipation of QuantumScape's potential growth in the electric vehicle sector, although some analysts suggest that AI stocks might offer even higher returns in the near term.
A recent prediction by a crypto analyst known as Crypto Kaleo suggests a monumental 2,600% increase in Dogecoin's value, potentially driving its market capitalization to $1 trillion. This projection, shared on social media platform X, is based on historical performance comparisons with Bitcoin, with Kaleo noting that during the last bull market, Dogecoin reached nearly 10% of Bitcoin's market cap. At the time of the report, Dogecoin was trading at 24 cents, having risen nearly 10% in the past 24 hours. The analyst's forecast, if realized, would see Dogecoin's price soar to approximately $6.94 per coin. The implications of such a surge are significant for the cryptocurrency market. Dogecoin, which originated as a meme coin, has already secured a place among the top cryptocurrencies. Achieving a $1 trillion market cap would not only reinforce its legitimacy, but could also impact the broader crypto market by spurring increased investor interest and potentially initiating a new wave of investment. This development highlights the growing influence of meme-based cryptocurrencies and their potential to reshape market dynamics, challenging traditional perceptions of value within the crypto space.
In a comparative analysis of Exxon Mobil, NYSE-XOM, and ENI, NYSEE, ExxonMobil emerges as a stronger investment option across various financial metrics. ExxonMobil reports significantly higher gross revenue and net income, with a revenue of $339.89 billion and net income of $33.68 billion, compared to ENI's $98.71 billion and $2.84 billion, respectively. ExxonMobil also boasts a lower price-to-earnings (PE) ratio of 14.31, indicating a more affordable valuation compared to ENI's PE ratio of 19.73. This suggests ExxonMobil might be undervalued relative to its earnings potential, making it an attractive option for value investors. From a profitability standpoint, ExxonMobil leads with higher net margins, return on equity, and return on assets, reflecting more efficient operations and better profitability. Additionally, ExxonMobil offers a stable dividend yield of 3.7% and has a long history of dividend increases, enhancing its appeal to income-focused investors. In contrast, ENI's higher dividend yield of 4.8% comes with a cautionary note, as it pays out 94% of its earnings, potentially risking future dividend sustainability. Institutional ownership further underscores ExxonMobil's market credibility, with 61.8% of its shares held by institutional investors, compared to just 1.2% for Eni. This strong institutional backing suggests confidence in ExxonMobil's long-term performance. Analyst recommendations also favor ExxonMobil, with a consensus price target suggesting a potential upside of 16.27% compared to a potential downside for Eni. Overall, the analysis positions ExxonMobil as the superior investment choice, driven by its robust financial performance, profitability, and market confidence.
Hassan Abdalla, the governor of the Central Bank of Egypt, led the Egyptian delegation at the recent G20 finance ministers and central bank governors meeting in South Africa. The meeting focused on macroeconomic developments, global financial architecture, sustainable finance, and Africa's development priorities. Abdalla emphasized the need for coordinated monetary and fiscal policies to maintain macroeconomic stability amid geopolitical tensions and trade conflicts. He advocated for reforms in multilateral financial institutions to enhance their efficiency and responsiveness, particularly in supporting lower-income and vulnerable countries through innovative financial tools such as reallocating special drawing rights, SDRs. Abdalla also highlighted the challenges posed by the rapid growth of non-bank financial institutions and the existing regulatory gaps, calling for improved international coordination to mitigate potential risks to global financial stability. On debt sustainability, he stressed the importance of dialogue between creditor and debtor nations and proposed extending the G20's common framework for debt treatment to include middle-income countries. Additionally, Abdalla underscored the need for expanded access to concessional and blended finance for developing countries, aligning external funding with domestic development priorities, and fostering public-private partnerships to advance strategic infrastructure projects. The discussions also touched on the importance of harmonizing environmental classifications and developing risk-sharing tools to attract sustainable investments.
Institutional investors have significantly increased their holdings in the Schwab U.S. Dividend Equity ETF, NYSEARCA, SCHD, reflecting a broader trend towards dividend-focused investment strategies amidst economic uncertainty and market volatility. Beckerman Institutional LLC raised its stake by 4.8% in the first quarter, making SCHD its ninth largest position, valued at approximately $2.93 million. Similarly, ETF Store Inc. increased its holdings by 14%, now owning 41,598 shares worth about $1.16 million. Other notable investors such as Bank of America Corp. DA, LPL Financial LLC, Investnet Asset Management Inc., Ameriprise Financial Inc., and Wells Fargo & Company MN have also expanded their positions in SCHD, underscoring the ETF's appeal. SCHD, which tracks the Dow Jones U.S. Dividend 100 Index, focuses on dividend-paying U.S. equities and boasts a market capitalization of $70.51 billion. It offers a relatively stable investment with a beta of 0.88 and an attractive price-to-earnings ratio of 14.57. Despite a slight 0.4% dip in its stock price to $27.02, its performance remains resilient, with a 12-month range between $23.87 and $29.72, appealing to investors seeking steady income through dividends. The increased interest in SCHD is part of a larger movement towards ETFs that provide inflation protection and growth opportunities. As inflation concerns rise and economic stability remains uncertain, ETFs like SCHD, the SPDR Portfolio S&P 500 High Dividend ETF, SPYD, Vanguard Dividend Appreciation Index Fund ETF, VIG, Vanguard S&P 500 ETF, VU, and Vanguard High Dividend Yield Index Fund ETF, VYM, are gaining traction. These funds offer diversified holdings across various sectors and focus on high dividend yields and quality stocks, attracting investors looking for stability and consistent returns amidst market challenges.
The financial analysis of Merck & Company, Inc., NYSE, MRK, and Innoviva, NASDAQ, INVA highlights a comparative evaluation of these two healthcare companies, focusing on their investment potential. Innoviva, a pharmaceutical developer, is currently favored by analysts over Merck, a well-established healthcare conglomerate, due to its stronger consensus rating and higher potential upside of 106.10% compared to Merck's 35.91%. Despite Merck's superior revenue and earnings, Innoviva's lower price-to-earnings ratio suggests it is the more affordable investment option at present. Institutional ownership plays a significant role in the analysis, with Innoviva boasting 99.1% institutional ownership compared to Merck's 76.1%. High institutional ownership is often seen as a vote of confidence in a company's growth prospects. Additionally, Merck's lower beta value of 0.39 compared to Innoviva's 0.37 indicates slightly higher stability in its stock price movements relative to the S&P 500. However, Merck outperforms Innoviva in profitability metrics such as net margins, return on equity, and return on assets, reinforcing its position as a financially robust entity. Overall, while Merck demonstrates strength in revenue and profitability, Innoviva's higher potential for stock price appreciation and strong institutional backing make it an attractive investment for those willing to assume higher risk for greater returns. These insights are crucial for investors looking to balance growth potential with financial stability in the healthcare sector.